Hi, this is Mitch Kramer. I'd like to welcome everyone to Fluent Financial's November webinar. Joining me on our webinar today is our portfolio manager, Trey Talley. And we're going to be focusing on the material that we normally do, what's going on in the markets, both the stock market and the fixed income bond market, the economic markets, and more importantly, how does this impact you and your portfolios and what we're doing to protect it and grow it. So the first slide we'll go through is the compliance slide. Any of the opinions expressed today by myself and Trey are ours and not private client services. So the first slide we wanted to go through, and this is one that you guys have seen before, is a leading economic indicator. And what it shows is this contraction that we have. Get rid of this. And what we have is these indicators have been going down for about almost 18 months. And anytime this happens, we have a recession, which is represented by these red bars. So we are going to have a recession, and I think more of the evidence that we show today will further back that up. So I'll go ahead and turn this over to Trey, and he'll give you kind of an update on year-to-date market performance in a little more detail about what we're going to be talking about today.
Good, thanks, Mitch, and hello, everyone. So we are starting here. This webinar will be a little more true to brevity here. So we're going to revisit the HOPE map. There are some updates we want everyone to be aware of. And so we'll discuss that. We'll discuss inflation and how it is coming down, but it is being a little persistent in its hanging around. And last thing we'll talk about is kind of just markets and their current churning between some of the optimism that a Fed pause is here, so we may have seen the last of the interest rate hikes, but they're on the counter side, they're reeling with the pessimism that is emerging from this weak economy. So that's kind of what we're going to discuss here. On the next slide here, we can kind of see some of the market returns here. So we've got kind of some of the more popular benchmarks there on the left. Our portfolios are on the right. So markets are still in this downturn that began in January of 22. It is extending across markets and assets. So we see several different stock indices down. We see the bond indices down. We see 60-40 down. So not a lot of places to hide here of recent. But year to date, that's contrasted with some nice bounces here in some of these indices. And so on both ends of the spectrum there, you kind of have the NASDAQ and then the bond market, which is still negative year to date. More interestingly, there's kind of this spread there between the NASDAQ and the S&P 500 equal weight. And so the NASDAQ is up almost 40%, contrasting that with the S&P equal weight, which just says there's 500 companies. I'm going to own an equal slice of the pie for each of them. And that is just marginally up year to date. And so the average stock is down on the year. Just marginally up on the year. It was down just a few days ago. And so there's really just 7 stocks that are holding up the market, the S&P, in their big concentrations of the S&P 500, even bigger concentrations of the NASDAQ. And so it's just these 7 stocks that everyone's kind of rushing to. They have strong cash flows, clean balance sheets, as things have been pretty murky in the economy. And so that we really like to stress that this is not a broad-based rally. It is a narrow, defined rally that is happening in just really just 2 handfuls of names. Small caps, equal weight small caps, these are indices that are still down about 30 to 40% if you do equal weight. So there is actually, in some pieces of the market, there is actually kind of a generational bear market that has occurred and is still ongoing. And so there is a lot of bifurcation in the economy. We can clearly see that here in the performance numbers. We'll kind of move on and talk about the HOPE cycle and some of the developments there.
Yeah, what's interesting here, Trey, is as we kind of alluded to last month, that the employment sector is going to be coming very quickly, and here it is. And we'll talk in more detail about that. But the HOPE slide, it's basically 24 months when the Federal Reserve starts to raise interest rates before the economy goes into a recession. Housing went in about 18 months ago, new orders about 15 months ago, profits up to this last month, we'd been stuck here, but now we're starting to see significant changes to the labor markets, which is the last shoe to drop before we hit a recession. And Trey, I'll let you talk a little bit more detail about this next slide. This is the government NBER group that basically determines whether we're in a recession or not.
Yeah, so this here, just some of the metrics that this agency looks at when declaring recessions, both starts and stops. And so red is obviously bad. That would be a recessionary signal. Green is more expansionary growth indications. And so what we see here across the spectrum is a gradual weakening into more of those kind of yellow colors there. And so on a coincidental level, we are edging closer and closer to a recession. There are some prognosticators that believe fourth quarter of this year, in hindsight, may have been the start of the recession. I'm not sure that I co-sign that view, but we're getting very, very close. We're getting a number of indications that have given us a 100% positive signal. And that's in the labor market. We'll discuss that here at the end of it. But we're not there yet, but we're getting pretty close. So we just want to make sure that we're being defensive. We've been arming our portfolios all year, and we'll illustrate that a little more later.
Yeah, and we tried to get a more current chart with data, and the last information we got, JP Morgan puts this out, was end of September. So this data is almost 90 days old. So we suspect when they produce this chart in the first part of January, you're going to see a lot more yellow and orange and potentially some red in some of these categories, but we'll cover that in our January webinar. So let's go back to a little more detail on the HOPE slide components.
So this is housing here. Again, HOPE is an acronym. It is a roadmap of how weakness starts and then cascades through an economy. It starts with housing, H. This here's home builder sentiment. Current readings 34. So anything below 50, it's declining. Anything above 50, it's improving. That would be the diffusion index here. So home builder sentiment had a nice little bounce there through the first part of this year. That was a point of optimism. That was a sign of life that the economy may be trying to restart itself. That has ultimately collapsed in the past few months as interest rates have gone back up and client demand has weakened. And so we are right back at the throes of kind of late last year when this reading was sitting there in its trenches. So home builder sentiment, very ugly right now. There's not a lot of sign of life in the housing market. In the building permits, which is the other piece of data that we illustrate here. Building permits really just kind of taking a rest stop along its journey downwards. And so building permits have been weak. We'd presume that they would get even weaker here. We think that we'll see that here in the next quarter. That's exactly what you see before a recession. Orders, new orders here. So we look at new orders. It's the first there among the production cycle there for companies. We look at manufacturing and services. Manufacturing here, again, kind of showing some life over the past, about 3 to 6 months, and it has ultimately collapsed again with housing. So it gave back all of those gains there. We're sitting back near the lows there in terms of the new orders. So back below 50 solidly, back into contraction there. And so there's no sign of life there in manufacturing. So not a lot in terms of optimism right there. And we see it also here in the services sector. This one moves a little slower. This one will go below 50 as we enter a recession, basically. We're edging closer there because that trend is lower. Profits, that is where we were stuck on for quite a few months. We see here corporate profits starting to take a little dip there. Companies have really leaned in. They've done a lot of cost-cutting measures. They've tried to protect earnings kind of at all costs through this inflationary wave, and as interest rates rose. So they've really extended all of their cost-cutting measures that they can. And so if we get a volume decline that happens generally through a recessionary environment, big layoffs, corporate earnings will continue to get punished. They've already started that in the back half of last year, and that's where we've been parked at for the current weakness. So that's where we have left. We have now kind of put the area of focus on employment. We've been teasing kind of this move for a couple of months all year. We've seen the leading indications of employment deterioration beginning to manifest. So here we arrive at the last acronym of the HOPE cycle. So this is initial claims for unemployment. It's picking back up, but it's really not off to the races yet. It's kind of a slow and then all at once phenomenon. We are seeing continued claims for unemployment continue to rise. We hit a new cycle high this morning. That means that if you are becoming unemployed, you are not able to go and find a job very quickly. So that's that first big indication that layoffs is the next big move, because hiring has ceased. Firing will begin pretty soon here. So unemployment rate, that's moved up to 3.9. So that's about 0.5% off the lows there at the beginning of this year. There are a lot of different fancy tools and models economists use based on the unemployment rate to predict a recession. We will not put anybody to sleep trying to go through them, but suffice it to say, we are at those signals now. One more employment report will all but confirm that. These are generally 100% predictors of recession. It doesn't tell us anything about the severity of it, but it tells us when it's coming.
Yeah.
So unemployment is on its way up for sure.
Yeah, and something that's kind of interesting, Trey, just some news bits from this week. Federal Express was telling its pilots that if there's openings at American Airlines, they should apply for those jobs. And the reason why FedEx was telling its pilots that, they are seeing a slowdown in the amount of shipments that they're sending, and they expect this Christmas season is going to be much weaker than prior years. So that's just another data point that shows a slowing economy. So let's talk a little bit about inflation as we look at this slide. This slide we shared with you guys in the past. We're at about 3.2%, this white line here. Really all the factors are starting to come back down. Energy is this red area here where you see some deflationary pressure. Food costs that have come down. Now, I know a lot of you may be buying goods for Thanksgiving. It's much higher than last year, but overall food is starting to come down, and then core services. So Trey, anything you want to add to that?
Inflation is coming down. We're mostly just dealing with the sticky pieces of it, wages, housing, stuff like this. We see no evidence of a second bump in inflation, like it was kind of happening in the 70s and I believe in the 40s as well. So we're getting inflation slowly but surely behind us. Still some sticky pieces around. That's kind of why the Fed's still got their nose in our business and stuff like that. Unfortunately, things are still getting more expensive, but we think we're getting closer to the exit of this. So that is good news ultimately.
Yeah, and a lot of people have asked me about why haven't we had this recession? Weren't you guys predicting a recession in 23? And this time last year we were. Well, the reason for that is the fiscal stimulus that the government put into our economy in 2020, all the way into beginning of 22. Kind of overheated the economy. So as that money gets spent and is now gone, now you have this inflationary pressure. That coupled with a very tight labor market, and the biggest challenges for businesses prior to COVID was finding and keeping talent. So those two factors have kind of delayed this recessionary pattern from taking hold, but that has passed, and we'll start to see it. I would be shocked if it goes beyond the first quarter of 24. Something totally different. We added this slide in here about China. We don't talk about China a lot, but after the supply chain issues and Xi is not friendly to the United States, he obviously doesn't think very highly of our current president. But you can see this foreign direct investment has now become negative in China. So what this is showing is businesses are recognizing that China is not a good place to do business as they were in the past. You can see this huge amounts of money. This is 50 billion. This is 100 billion. So almost $12 billion has been yanked out of China. And we think this trend is going to continue because of the politics of the CCP, the theft of intellectual property, the lack of respect of human workers, et cetera. I can go on and on and on. But China's got some significant problems, and we'll continue to keep an eye on it. But I thought this was kind of a really interesting chart. The next area is the consumers are out of money. They're tapped out. And you're starting to see the default rates. First chart here on the left is auto loans. Credit cards is out here on the right. And this is percentage of balance on the x-axis, and this is years here. This is the big spike during the Great Recession. Here it is here, and you can see here on the right-hand side of this, the numbers are going up pretty significantly. The people that are impacted the most by this are the youngest millennials, 18 to 29, and the older millennials, 30 to 39, and Generation Zers. And what's interesting is this is not including the student loan debts that were turned back on. They started making payments again in October. So a lot of your consumers who normally would buy lots of goods and services, they're establishing households, buying houses, buying furniture and goods into houses, they don't have any money. And part of the problem is they have huge student loans because our colleges don't understand that you can't continue increasing prices each year, but the colleges think, well, if you don't pay it, there's 200 people behind you that will. As we go through our plans, it just blows me out of the water. SMU now is $83,000 a year, Baylor $71,000, USC's over $100,000 a year, and that's just ridiculous. And just to put it in context, I went to Texas Tech from undergrad, 81 to 85, all in 4 years, 26,000. So it's just ridiculous what's happened to college costs. But when you crowd out people's ability to buy goods and services, that would have a negative impact on our economy, will cause a recession. And businesses are aware of this because if you look at their seasonal hiring, this is from Challenger Great Christmas. If you look here to the right, 22 and 23, the number of seasonal hires is really significantly less than 2021. We're going back to numbers almost 10 years ago. We have a lot more Americans living here. And no, it's not robots that are replacing people at Walmart and self-checkout. This is just companies recognizing that they're not going to have a great holiday season. They don't want to incur the overhead and hiring a bunch of people. So the next chart, we want to put some good news in here, is how are we doing as a country in terms of a consumer balance sheet. So if you look at assets, and this is through October, assets that we own as Americans is 174.4 trillion. A trillion with a T, and we have debts of about 20.1 trillion. So we have very solid balance sheets overall. Now, Generation XY, baby boomers, and the greatest generation, most of us don't have a lot of debt left. So our balance sheets look very strong. XYers are probably in a transitional phase. They're 40s and 50s. So the typical American who's entering retirement is actually in much better shape. This chart here shows household debt service ratio. It goes back to 1980. This is the percentage, 10.6, hit a peak just before the Great Recession of 13.2. Now it's rising up to about 10%. So still relatively low compared to historic measures. But down here, flows into early delinquencies. We shared this on one of the prior charts. You see the spike up for cars and credit cards. Student loan is very low, but again, student loans were just required to be payments being made on them in October. We anticipate that will go up. So let's talk. I want to change gears here and give this back to Trey. Talk about some opportunities in the treasuries and the bond market.
So here is we're looking at kind of the relative attractiveness for bonds versus stocks here. And so this is a chart of what we call the equity risk premium. And so if you are given a decision whether you want to invest in stocks or bonds, what are the relative returns of those look like? If you could invest in a bond and earn 5%, in a stock and earn 5%, well, you would never do the stock because it's more risky. And so what we're looking at here, kind of y-axis here is kind of the is that equity risk premium. You can see this going back across over about 24 years, really. And so that gray line is indicating, as it's moving up, it's indicating bonds are relatively more attractive than stocks. So you should be overweight bonds and underweight stocks. And of course, the inverse for that relationship. So right now, that gray line is not only moving up, it has moved up a lot. And it is above about one standard deviation of the average over that about 24-year period or so. And we are seeing a very attractive opportunity relative to these two investment assets in bonds. Bonds are attractive here versus stocks. It doesn't mean stocks are doomed. It just means that the risk you have to assume to be investing in stocks probably doesn't compensate you near as much as it does investing in bonds at this current point here. And so we have some other slides that kind of help illustrate that, but this is an area where it's really no brainer. If given the option between bonds and stocks, it's bonds. Yeah. High quality bonds.
And Trey, I think this chart here does a great job of showing how strong the bond market is and kind of the asymmetrical difference between rises and decreases and how much more bias there is if rates do fall.
Exactly here. So this chart is on the left, kind of looking at just different maturities there of Treasury bonds, and then across the top there, we're just looking at theoretical changes in interest rate. And so, kind of want to focus on the 30-year because that's where it all gets magnified out there. So, if interest rates are to rise 3% from here, that 30-year bond would fall about 30%, because as interest rates go up, bond prices fall. There's that seesaw effect. And so, so 30% is not great. But we contrast that. It's always risk relative return. We contrast that. If we take the same theoretical exercise and bond rates fall 3 percentage points, so 300 basis points, that return on that bond would be almost 75%. So you have 75% to the upside versus 30% to the downside. So you kind of have a 2-to-1 R ratio. So risk is 1 and return is 2. And so what it does show, to Mitch's point, is an asymmetry of investment here in fixed income. And so you're actually incrementally being more rewarded if rates fall versus a rise here. And with the view that we're probably at or close to the peak Fed funds rate here, so meaning the Federal Reserve will not be hiking rates from here. They've hiked them up far enough. They've damaged the economy enough. They are sitting tight. And so if that's the view, long-term bonds around this neighborhood are going to start peaking out, and rates will kind of stop going up. And so as rates are peaking, you want to be buying bonds because that means bonds are bottoming. So this does illustrate the great risk-reward opportunities that are available in bonds. That has not been the case for definitely 10 years, maybe 15 years really in the bond market, but it is now. And so equities priced richly, bonds priced cheaply. We buy low, sell high. It's pretty easy.
Yeah. And I think what's interesting is, and this next graph explains it, when do we expect rates to come down? In this graph, it's the CME Fed Watch, and you can look at this daily. And I'll kind of frame what you're looking at. This is when the Federal Reserve is scheduled to meet here on the y-axis, and then the column headings here represents the current Fed funds rate. So we're currently at 5.25 to 5.5, and there's 100% certainty, according to the bond market, the Fed's not going to raise rates. But what's interesting is when we shared this chart with you guys last month, they were going to keep rates at this same level until July. But what's happened in the last 30 days, the economic conditions are deteriorating. Now they're expecting to have a rate cut happen in May. Is it going to happen sooner than that? I don't know, but that's just what this graph shows. And if you guys want to know, a lot of people say, what is your stock tip? This is a ticker symbol, EDV. It's a 25-year ETF of Treasury bonds. Vanguard makes it. If you want to buy this in your own accounts, or if you can get it in your 401k, this is something you got to put some money in, because I think you're going to have some nice gains in this in the next 12 to 24 months. We're personally putting money in this ourselves. We put it into our model portfolios, and Trey used the comments, made a nice stocking stuffer for our clients, maybe this year, but definitely probably next year. So, Trey, anything else you want to add?
Yeah, we're getting to the tail end of this interest rate hike stuff here, and we're focused kind of on what comes next. So there's going to be a bumpy ride here as employment does its thing. Fixed income, we like bonds. We like high quality bonds, no high yield bonds. So if you hear anybody talking about high yield bonds, stay away from them. They trade like equities. That's not what we're talking about here. We're talking about high quality bonds that we can extend some duration. That's what that EDV is. We've plugged it across a number of our portfolios, and this is an ETF that is designed to rise as interest rates fall. That generally happens in the context of a recession and a weak stock market. So we think that that's a great inverse hedge here in a way to reduce risks all across the portfolios.
So the next slide, as we kind of wrap up, this is our options portfolios. And again, if we have $1 million in a portfolio and you're in one of these three portfolios, Advantage, Advantage Plus, or Stock Income, this is what we'll target. We'll produce an income for you. This is the amount in dollars. This is what we actually have done the trailing 12 months. What's been interesting is Advantage has really produced quite a bit of income. I think a lot of this has to do is because a big chunk of this is in the NASDAQ index, the cubes, Q. and then the S&P 500. So we've had better appreciation, so that's better income generation. Stock income has done a little better than 8%, so it's still doing what we expect it to do. So that those portfolios have worked well for people. If we go in the Q&A, before we do this, a comment's been made. Goes, well, you know, you guys have been risk off. If we'd like to see, hang on 1 second here, guys. We had this issue this morning here. Go back. What about if we want to take risk? Are there portfolios you guys have? And we have a portfolio called G&O that we have. It's been incubator. It's not been out live, but Trey has been managing it for a number of years. And in 2020, it did 70%. In 2021, it did 37%. So when it's a risk-on trade, we'll make the decision to take more risk in portfolios. But right now, as we're entering winter, you know, it's not time to, you know, get ready to jump on the pool. It's going to be pretty dang cold. We just want to be cautious. Sometime next year, it's going to be a much better time to be risk on. So I'll go ahead and stop the recording and open this up for any questions.